Alright, let's address what's being talked about right now, because there's a lot of energy building, and it's important to anchor this discussion before people start forming expectations that aren't realistic. Jake Claver is saying that we're essentially at the doorstep, that depending on how Japan handles interest rates, Friday or Monday could turn explosive. He's directly pointing to a potential yen carry trade unwind and suggesting that if the Bank of Japan acts aggressively, markets could move very quickly. And it's easy to see why that storyline is catching on, because at first glance it sounds straightforward. Japan hikes rates. The yen carry trade unwinds. Liquidity shifts. Risk assets respond. XRP benefits. A clean and simple chain of events. But markets are never that clean. And if you don't actually understand how this mechanism works, you're very likely to misinterpret both the timing and the result. Let's start with what Jake actually said, because context is everything. He outlined 3 different scenarios. A 25 basis point hike would probably result in a slow adjustment, nothing dramatic, no sudden moves. But if Japan goes with a 50 or 75 basis point increase, that's where things become aggressive. That's where leverage tied to cheap yen funding starts to unwind under pressure. That's when real stress begins to show up across global markets. And yes, that's also when sharp moves in crypto can occur. But here's the critical detail that a lot of people are overlooking. The market is already expecting a rate hike. There's roughly a 98% probability priced in that Japan raises rates, with 0.75% being the highest level seen in roughly 3 decades. So the real question isn't whether Japan hikes. The real question is how large the hike is, and more importantly, how markets react after the decision rather than before it. For decades, the yen carry trade has quietly powered global liquidity. Institutions borrow yen at extremely low rates, convert it into other currencies, and deploy that capital into stocks, bonds, real estate, and crypto. It's cheap leverage. When Japan raises rates, that leverage becomes more expensive, and positions that only made sense in a zero-rate environment start to fracture. When that unwind begins, it is not bullish in the short term, and that's the part people need to hear clearly. Unwinds start with liquidation. They bring volatility. They trigger forced selling. Liquidity shocks don't begin with prices going straight up. They usually begin with stress. So when people talk about a happy Monday, they're skipping straight to the final scene without watching the opening act. Could XRP benefit once liquidity reshuffles? Yes. Could XRP become more relevant if the existing system starts showing cracks? Possibly. But those are second-order effects, not immediate reactions. And this is where a weak assumption needs to be challenged. The idea that XRP will surge simply because Japan raises rates is flawed. One does not directly cause the other. XRP doesn't rally just because a central bank tightens policy. What XRP responds to is where liquidity eventually flows, not where it temporarily breaks. If Japan tightening creates stress, the initial response is risk-off. That is not immediately bullish for crypto. The opportunity appears later, when capital starts searching for more efficient rails, better settlement, improved yield, and lower friction. That's where XRP's actual thesis exists. So if you're waking up Monday morning expecting instant fireworks purely because of a rate decision, you're setting yourself up for disappointment. And disappointment is what causes people to sell at exactly the wrong time. The more important question, right now, isn't whether price explodes on Friday or Monday. It's what happens to liquidity after leverage unwinds, and who benefits when the system needs better infrastructure. Because that's where XRP really enters the discussion, not as a hype asset, but as plumbing. And in the next phase, the focus shifts to why Ripple's position today looks very different from previous cycles, and why stablecoins, hidden road, treasury settlement, and yield change the equation entirely. Stay with me, because this is where surface narratives fall apart and the real story starts. Now let's go deeper, because this is where most people misunderstand what's actually happening. When carry trades unwind, the first stage isn't opportunity, it's damage control. Funds don't rotate smoothly from one asset to another. They sell whatever they can, wherever they can, to reduce leverage. That means crypto, equities, and other risk assets can all get hit at the same time. So if Japan moves aggressively with a 50 or 75 basis point hike, the immediate reaction is not institutions rushing into XRP, it's forced liquidation elsewhere. That's how these events have always played out. Liquidity doesn't teleport, it panics first. This is why anchoring expectations to specific days like Friday or Monday is dangerous. Markets don't move according to your calendar. They move according to balance sheets. If leverage starts coming off, that process can take days or weeks, not hours. Anyone promising instant upside is skipping the uncomfortable part. But this is where XRP becomes interesting after the unwind. Once leverage clears, two things happen. Weak structures fail, and capital starts looking for efficiency. After the dust settles, institutions reassess how to move value with less friction, less trapped capital, and better yield. That's the environment where XRP's use case actually matters. Look at the current system. Banks are sitting on trillions of dollars in dormant capital through Nostro and Vostro accounts just to move money across borders. That capital earns nothing. It's dead weight. In a higher rate world, dead capital is unacceptable. Every basis point matters when you're managing trillions. Now imagine a system where that capital doesn't have to sit idle, where liquidity can earn yield and still be available instantly when needed. That's not a luxury, it's a competitive edge. And that's exactly the problem Ripple and XRP were designed to solve. This is why tying XRP's future to one macro event misses the bigger picture. Japan's rate hike isn't the catalyst, it's the stress test. Stress reveals inefficiencies. Inefficiencies create demand for better systems, and demand is what ultimately drives adoption. This is also why short-term disappointment is built into shallow thinking. If Monday comes and nothing dramatic happens, that doesn't mean the broader thesis is wrong. It means the process hasn't finished. Real shifts don't announce themselves loudly, they show up quietly through changes in behavior. Liquidity flows differently. Settlement preferences evolve. Institutions begin favoring rails that weren't previously essential, and this is where Ripple's current position matters more than short-term price. Ripple today is not the same company it was in 2017 or 2020. It now has a pathway toward banking licenses, a regulated stablecoin, institutional prime brokerage through Hidden Road, and access to treasury-level settlement flows. That changes how XRP fits into the system after volatility, not during it. This is where the conversation moves from macro theory to incentives, because institutions don't allocate capital based on stories, they allocate based on math. When you run the numbers, you understand why this transition isn't optional anymore. Consider trapped capital. The global banking system still relies on the Nostro-Vostro model, which forces banks to pre-fund accounts around the world just to move money on demand. That capital sits idle. It doesn't earn yield. In a low-rate environment, that inefficiency was tolerated. In a higher-rate, tighter liquidity environment, it becomes a liability. Now connect that to what's being built. If a bank can hold capital, earn even 1 to 3% yield, and still deploy liquidity instantly when required, the incentive structure changes completely. 1% on trillions of dollars is enormous. 2 or 3% is transformative. That's not retail yield chasing, that's global balance sheet optimization. This is why Ripple's strategy matters. You have a regulated stablecoin. You have institutional prime brokerage via Ripple Prime. You have treasury settlement through acquisitions. And you have XRP positioned at the center as a neutral liquidity bridge enabling instant settlement. Put together, this isn't a retail exchange competitor. It's back-end financial infrastructure for banks and institutions that don't care about charts, they care about efficiency. This is also where people underestimate how quickly behavior changes once regulation becomes clear enough. We already saw stablecoin frameworks advance in 2025, with broader clarity expected next. Once rules are in place, institutions don't debate whether to adopt, they debate how fast they can move without falling behind competitors. Yield creates urgency, it creates pressure. No CFO wants to explain why a rival earns more on idle capital, simply because they upgraded infrastructure sooner. This is why price can lag while positioning accelerates. These systems are integrated quietly through pilots and private liquidity channels. Nothing flashy appears on charts while foundations are being laid. So when people say nothing is happening, what they really mean is nothing visible is happening to price. Meanwhile, incentives are shifting underneath the surface in ways that don't reverse. This is where supply and demand come into play, and this is the part that makes people uncomfortable. OTC markets exist to avoid slippage. Large players don't chase price, they negotiate supply patiently. But that only works while supply is available. There are only a few sources of meaningful XRP liquidity: exchanges, OTC desks, and Ripple's escrow. Each has limits. Exchanges lack infinite depth. OTC desks require willing sellers. Ripple is not obligated to sell on demand, especially if strategic uses are prioritized. This is where conditions can change faster than people expect. As ETFs enter, even modestly, they introduce persistent structural demand. Firms managing tens or hundreds of billions are not niche players. And while many wait for household names to announce moves, the reality is that institutions respond to client demand and regulatory readiness, not hype. Tokenization accelerates this further. As real-world assets move on-chain, settlement speeds up, capital moves more frequently, and systems that rely on neutral bridge assets become more valuable. XRP doesn't need to replace everything. It only needs to sit within critical flows. That's why people are often blindsided when price finally moves. It's not because something new suddenly happened, it's because supply quietly tightened, while demand became unavoidable. Markets then reprice aggressively. This doesn't mean a straight line upward. Volatility increases, weak hands exit, strong hands absorb. But the character of the market changes. Pullbacks become shallower, recoveries become quicker. Liquidity starts driving price instead of sentiment. This is why focusing on a single rate decision misses the point. Those are sparks, not the fire. The fire is being built by regulation, yield, tokenization, and institutional behavior shifting together. So let's bring this back properly. What's being highlighted isn't a guarantee of a specific day explosion. It's recognition that the system is under stress, and stress accelerates change. If Japan hikes aggressively and the carry trade unwinds sharply, the first reaction can be messy. Volatility, drawdowns, confusion. That's normal. XRP doesn't magically jump because something breaks elsewhere. What matters is what happens afterward, when institutions reassess where capital belongs. That's where XRP's position becomes powerful. Ripple today is not just a payments company with a token, it's a full stack. A regulated stablecoin, institutional brokerage, treasury settlement, access to yield, and a neutral bridge asset that moves value instantly, globally, and continuously. That stack didn't exist in previous cycles. Comparing this moment to earlier cycles is lazy analysis. At the same time, this doesn't mean instant wealth or straight-line moves. Markets reward patience, not excitement. The real risk isn't that nothing happens on Monday. The real risk is misreading silence or volatility as failure and exiting just before the system begins demanding what XRP provides. Infrastructure doesn't announce itself loudly. It becomes obvious only after it's embedded. Manage expectations. Don't anchor to dates. Don't let certainty be sold where none exists. Focus on the phase we're in. Regulatory alignment, institutional positioning, yield infrastructure, and tokenization moving forward together. These are slow processes that lead to sharp repricing later. And to be clear, none of this is financial advice. This isn't a prediction or a recommendation. Always do your own research and understand your own risk. Crypto is volatile. But if you understand what XRP is designed to do and why stress accelerates adoption rather than stopping it, you stop obsessing over single days and start thinking in systems. That's where the real edge is.